Welcome back to The Explainer. If you've been watching your portfolio lately, you already know the financial landscape in August 2026 feels, well, exactly like a pressure cooker. Today, we're breaking down why the market is currently trapped between two massive, colliding economic forces and what that actually means for your money. Let's jump right in.
Right now, the market is literally holding its breath. The S&P 500 is completely flat, just hovering around a negative 0.02% daily close. And the trading volume? It's telling the exact same story. We're looking at 13.61 billion shares, which, by the way, is the second lowest volume level of the entire year. So why the standstill? Because institutional investors are bracing for impact. We're staring down a massive dual catalyst event this week. On one side, we have Nvidia's highly anticipated earnings report, and on the other, the Federal Reserve's Jackson Hole Symposium. Basically, it's the unstoppable tech boom crashing headfirst into a harsh macroeconomic reality.
Here is our roadmap for today to make sense of all this. 1. A tale of two markets. 2. Nvidia and AI dominance. 3. The macroeconomic debt crisis. 4. The Jackson Hole ultimatum. And 5. The hard asset synthesis.
Let's kick things off with Section 1, a tale of two markets, the 2026 divergence. Okay, to really grasp this, we have to recognize that we are navigating a deeply bifurcated economy. On one side, we've got this tech comparative. The reality is, everyone is being forced to participate in this massive computing shift, and that demands building infrastructure at a tremendous, almost unthinkable cost. But here's the catch. This infinite growth engine is slamming straight into a macro reality. Sovereign debt has become structurally unmanageable across the board, and that golden era where central banks could just easily absorb deficits, yeah, that's officially over. These two completely opposing realities just cannot exist in harmony forever.
Moving right along to Section 2, Nvidia and AI dominance, the engine of infinite scaling.
Let's look at the sheer scale of what is happening with Nvidia, because it is truly historic. They are officially shattering the $100 billion ceiling. We just saw adjusted earnings of $2.22 a share, with Q2 revenues hitting an incredible $96.2 billion. And it doesn't stop there. The projection for Q3 hits $108 billion. Looking a bit further out, they are forecasting an absolutely staggering 70% revenue growth for fiscal 2028. Now, the only slight hiccup the market is keeping an eye on is a tiny 1% dip in adjusted margins. It's triggered some minor fears about whether they're hitting a pricing power ceiling at these extreme altitudes. But make no mistake, the growth engine itself is absolutely roaring.
Now, to secure that insane future growth and actually, deliver on those promises, Nvidia has made a commitment to its suppliers. Are you ready for this number? $279 billion. Just let that sink in for a second. That is capital being deployed entirely to bypass supply constraints. They want to guarantee those AI chips keep flowing no matter what.
But this brilliantly illustrates the really delicate balancing act of making a commitment like that. See, during a boom, writing those massive checks greases the wheels of the supply chain. It guarantees you a strategic advantage so you can hit those lofty revenue forecasts. However, that exact same sum acts as a financial backstop for their less credit-worthy customers. It's basically insurance. If end demand suddenly drops for any reason, bam, that strategic advantage instantly transforms into a very painful, very heavy financial liability.
For now, though, this AI engine is powering absolutely everything downstream. Nvidia sits right at the center, creating this massive ripple effect across all of enterprise software. Think of it as the shield, driving the best quarter on record for cybersecurity firms like CrowdStrike, which saw a massive 8% pre-market jump, and boosting companies like Okta as everyone scrambles to secure rogue AI agents. It also acts as the engine for enterprise integration. We're seeing bumped forecasts for Salesforce and major new integrations like Claude Perforce. Yet running parallel to this unprecedented corporate windfall, we are getting serious systemic warnings. Figures like Bill Gates are out there cautioning us about the massive human upheaval that's going to result from all this rapid technological acceleration.
Which brings us to Section 3, the macroeconomic debt crisis, the immovable object.
So what happens when that unstoppable tech scaling meets an immovable object? The contrast between the last decade and today is just staggering. Back in the 2010s, we had a very manageable deficit at 2.8% of GDP. Short-term rates were essentially anchored at zero. We had a calm bond market staying below 2%, and we had clear forward guidance. The Fed explicitly told us what they plan to do next. Fast forward to 2026, it's a night and day difference. We are facing nearly 6% deficits. The Fed absolutely refuses to give future hints, relying instead on really strident inflation rhetoric. Short-term rates are elevated and the bond market is in a full-blown panicked sell-off with yields crossing 5%. We are operating in a completely different paradigm right now.
The structural foundation of the global economy is genuinely shaking. The PCE inflation gauge, which is the metric the Fed actually cares about most, is stubbornly holding at 3.7%. That is way above their 2% target. 30-year Treasury bond yields have spiked from 5.09% to 5.31%. And hey, this isn't just a US problem. Global debt contagion is actively spreading across France, Italy, the UK, and Japan. Things are getting so stressed out there that Treasury Secretary Scott Bessent has been forced into some highly unusual market interventions. He's literally having to buy back long-term bonds just to prevent a market collapse. The really crucial point here is understanding this vicious cycle we're trapped in. It starts with those stubbornly high deficits sitting at nearly 6% of GDP. That triggers a bond sell-off, which pushes yields up. Well, higher yields mean higher debt servicing costs for the government, which forces even more borrowing, which expands the deficit even further. It's a closed doom loop of fiscal stress. And ultimately, governments caught in a loop like this are going to choose currency debasement, quietly inflating away your purchasing power, rather than facing a catastrophic, politically devastating default.
Section 4. The Jackson Hole Ultimatum. The collision point.
So this pressure cooker is centered squarely on Fed Chair Kevin Warsh, and he is caught in a seriously tight vice right now. The market is demanding clear explanations of where the economy stands. Investors desperately want some kind of assurance against inflation, but Warsh's ideological stance is the exact opposite. He has actively campaigned against forward guidance and is deeply reluctant to explain any hesitations on rates.
The stakes for Warsh at this symposium represent a completely binary outcome. He's got two choices. He must either validate the Treasury's recent, highly unusual market interventions to help lower those yields, or, if he decides to hold his ideological line, he risks landing the Treasury in even deeper trouble by sending yields even higher. The entire market is sitting on its hands, waiting to see which path he takes.
And finally, Section 5. The hard asset synthesis, the flight to scarcity.
So how is institutional capital synthesizing this crazy high-stakes standoff? They're executing what's known as the debasement trade. And the logic here is actually beautifully simple. When you take infinite tech value creation, like those $108 billion quarters from Nvidia, and combine it with infinite government debt printing, the natural result is a massive capital flight. Institutional money is aggressively chasing mathematically scarce assets. They want things that simply cannot be created out of thin air or arbitrarily diluted by a government.
We can actually track this flight to hard assets really clearly by looking at Bitcoin's trajectory. Starting from its October 2025 breakout peak at $125,000, it projects a mid-2027 hype base target of $150,000, eventually moving through a 2029 correction and aiming all the way toward an accumulation target of $1 million by 2033. And that $1 million target, that tracks just 1.2 times the cost of the least efficient miners. Put simply, the asset is entirely priced on the sheer energy required to produce it, which creates an absolute hard floor based entirely on structural scarcity.
Now, what's truly fascinating is the intense level of that structural scarcity currently at play. A staggering 60% of holders have refused to move their assets in the last 12 months. They are holding steady despite a 50% market pullback. Meanwhile, institutional access is rapidly evolving through corporate proxy strategies, specifically MicroStrategy. With their share price target slightly adjusted to $350, if those preferred shares recover to their $100 face value, their buying strategy goes totally kinetic. We are looking at the potential to drive a massive 30% premium above the cash value of their holdings by June 2027.
And you know, even while all this macroeconomic chaos is unfolding, the corporate gears just keep turning, completely unbothered. Take Meta. They recently settled with 48 state attorneys general for a whopping $18 billion, agreeing to implement a 2-hour time limit for users under 18, and their stock actually went up 1.1%. Why? Because the market loves seeing them stave off larger regulatory threats. Meanwhile, you have Vanguard deploying $4 billion to acquire Altruist in a direct, heavy assault on competitors in the independent financial advisor space. Wall Street continues to consolidate, regardless of what the Fed is doing.
So, bringing it all together, the ultimate takeaway from this explainer is this. In a market bifurcated by infinite technological scaling and infinite fiat debasement, capital inevitably flows toward mathematical scarcity.
Capital is always going to seek safety and absolute certainty when both tech and debt seem to be scaling toward infinity.
Which leaves us with the single most important question for August 2026, and one you need to keep top of mind as this entire week plays out. As these dual engines collide, as Nvidia drops its historic earnings while Fed Chair Warsh takes the podium at Jackson Hole, which infinite force is going to break first? Will it be the AI tech boom, or will it be the US Treasury? Thanks so much for tuning into The Explainer. Keep your eyes on the charts, and we will see you next time.